online application form, and within seconds, thanks to their automated underwriting system, you've been approved.
By 2007, the system had been used to produce $450 billion of subprime loans. Fannie Mae and Freddie Mac crashed in September 2008, requiring a massive government bailout. Regulation had failed despite the attentions of the watchdog. Well, they had 236 employees. Added together, all 236 still earned less than Fannie Mae's boss, Franklin Raines. Back in Britain, Northern Rock was emulating the same model. Instead of funding its loans and mortgages out of its savers' deposits, Northern Rock funded itself by borrowing in the money markets to offer mortgages of up to 125%. While it lasted, they were the toast of the Northeast. When the money markets dried up, they were just toast.
So, George Parr, as an investment banker, why are we so poor when last year we were so rich?
Well, of course, I still am rich.
Indeed.
But I take your general point. Partly it's to do with the business cycle.
The business cycle. Now, how does that work?
The market is a very sophisticated mechanism. Sometimes it goes up and sometimes it goes down. When there's more greed than fear, it goes up. When there's more fear than greed, it goes down.
So you're saying the banks have been too greedy?
Oh, no, not at all. Not at all. The opposite is the case. The banks have always been noted for their public spiritedness, for having the interest of the poorest in mind.
Have they? I must have missed that.
Oh, no, certainly. Over the last few years, the banks have been saying to themselves, we've lent all the money we can to people who've got some assets and some prospects. How can we start lending to people who haven't got any money or prospects or any hope of paying it back?
The banks were being compassionate, were they?
Oh, very, very much so, very much. And, of course, we can charge much higher interest to those sort of people. A commercial bank will go to one of their poorest customers, say, I don't know, a single mother who hasn't worked for 5 years, who's constantly going over her credit limit, who's behind on her credit card payments, who can't keep up the mortgage. And then somebody will ring her up and say, how would you like us to lend you the money for a new conservatory?
And what does she say?
She says she's not sure about it.
Why not?
Because she lives on the 10th floor of a tower block. But the man at the bank goes on trying. And what you have to remember is these people are really desperate.
The people in the tower blocks?
No, the people at the bank. No. They're not paid very well, so they need their sales bonuses to make a decent living. So this woman gets a second mortgage.
But isn't that terribly risky for the bank?
Well, you'd think so, wouldn't you? And so would I, but then I'm not very good with figures. But I have some very clever chaps working for me who are, and they found a way around this risk. They came up with what's called securitization.
And how does that work?
It's absolute magic. The first thing is, it's no good for the bank just to hold on to a mortgage on its own. All it means is we get some pathetic dribble of interest every month for the next 30 years. It does absolutely nothing for our bonuses.
You might not live that long.
That's slightly unnecessary, if I may.
I'm sorry.
No, but you're right. So what we do is to take this mortgage, we put it together with a lot of other mortgages and bits of debt, and pass it up into what is called a structured investment vehicle, or a collateralized debt obligation, and we sell it.
The advantage of that being
that we can book the whole lot straight away as a big profit, and that does wonders for our bonuses.
And you don't have to wait 30 years for the money.
Precisely.
But a risky loan is still a risky loan, isn't it?
Not if you pass it up with a lot of other loans, and some other loans are of good quality. If you do that, the bad loans somehow get better.
All on their own?
Sort of all on their own, yes. I mean, we're in very deep waters here, mathematically. I mean, the people who devise these financial instruments are incredibly clever. You see, one of the things which makes loans risky, when you mix them all up together, is what is called correlation. If one very risky loan is put in with a lot of other loans which are very much the same, it increases the risk.
Because if one goes bad, the others are very likely to.
Exactly. So we had to be sure there was very little correlation in the loans in a CDO.
Such as there being a lot of subprime loans to American house buyers with no chance of paying them back.
Yeah, well, of course, it's easier to see that now.
But everybody in the market had confidence in
Absolutely, absolutely. Well, let me put it another way. Not everybody in the market had confidence in it. In fact, nobody did. The key thing is we all behaved as if we did.
Didn't it worry you that you didn't understand these things, these CDOs or the formulas?
Of course it didn't. In fact, it would have worried me if I had. Because if I could understand it, anybody could. Not just the quantification experts who worked for me. And if anybody could, then anybody could make billions like me. And where would that leave us all?
So the point is you believed in these things.
I believed in them. And more important, I believed that everybody else believed in them. I mean, it's like religious faith. You don't believe in the existence of God because it's obvious. You believe in it because it's mysterious. It passes our understanding. Certainly these things passeth my understanding. In fact, it hurteth my mind just thinking about it.
Wouldn't it be better if there were some independent agencies which could help just set the price of these very complicated financial instruments?
There are. There are firms like Standard & Poor's and Moody's which put a credit rating on different forms of investment and get paid a fee.
Who pays their fees?
Whoever is selling the investment.
Isn't there a huge conflict of interest there? I mean, surely there's a massive temptation for fraud. Giving a top credit rating to things which didn't deserve it.
Well, certainly, when it came to these things like CDOs and SIVs, the agencies consistently gave AAA ratings to what the Financial Times called grotesque risk monsters. But I don't think fraud was involved.
Well, why did they do it then?
Well, the analysts who work for the credit rating agencies aren't very well paid. They get very small bonuses, so all the smart people left for the banks and the hedge funds. So, as the FT once again said, leaving second-rate employees to rate complex deals they didn't understand.
So, you're saying it wasn't criminal, it was stupidity?
Stupidity and incompetence, that's all. And that's something we can be very proud of.
What happened to the system where a banker actually got to know the person wanting a loan and made a judgment about how risky the loan was likely to be? Isn't that a better way of doing business?
Oh, my goodness, no, all that went out with the ark. You can never make any serious money doing things like that. And the market's far too big. Have you ever heard of credit default swaps?
No, vaguely.
Well, they're a very ingenious way of insuring against companies defaulting on loans. At the end of 2006, the market in credit default swaps was $54 trillion. That's two-thirds the size of the total global economy.
And the point of them is what?
To decrease the risk of a crisis in financial markets.
Well, did they work?
No. As it turned out, they actually increased the risk of a global financial crisis.
So where did it all start to unwind? What happened? Didn't you have any inkling that something was about to go terribly wrong?
Well, what everybody thought was it didn't really matter if things went wrong, or if we made mistakes, or if people defaulted on their mortgages.
Why not?
Because property values would go on rising and all the mistakes would be cancelled out. Now, I've been working in the city for 40 years, and if I've learned nothing else, and I have learned nothing else, there is an absolute rule that property values never go on rising forever.
That's the rule.
That's an absolute rule. They never have and they never will. Only a complete idiot would think otherwise.
Right.
Except that just this once we thought they would.
But the American housing market began to collapse, and that affected all those complex financial instruments, the CDOs and the SIVs.
Indeed, sales of asset-backed CDOs fell from $227 billion last year to less than $1 billion this year.
Well, why did it happen so suddenly?
Because some idiot somewhere asked a question that should never have been asked.
Which was what?
Which was, how much are these things worth?
And then the whole thing unravelled.
Yeah, it makes you weep, doesn't it? If they'd have kept quiet, things might have just gone on as they were. Oh, for the good old days.
Now we are beginning to see something of what a mortgage banker really does. The full and active life he leads. Much of it behind the scenes.
All that mattered was that everyone was in on the craze. As Chuck Prince of Citibank put it, as long as the music's playing, you gotta get up and dance. And we're still dancing. When the music stopped, Citibank lost billions in everything from mortgages to credit cards. While Chuck was dancing, others were involved in more serious pursuits. James Cain, The boss of Bear Stearns was on a course.